innovators, millions of dollars in technology and software, customized systems, digital mobility. Yes, now that's banking at its finest. Hi, I'm Chisteria. I'm one of the members of Business as Usual. I, alongside of my group members and the persons of Brianne, Shawana, Hank, and Simon, will be presenting to you today Banking at its Finest, BBVA's Automated Loan Application Software Systems. BBVA is the largest financial institution in countries such as Mexico, China, Hong Kong, Switzerland, Japan, Turkey, and the United Kingdom, just to name a few. And BBVA is one of the largest international financial institutions here in the United States. Taking root in 1962 in Birmingham, Alabama, which is considered the headquarters of BBVA United States, BBVA has an astonishing 672 branches located here in the United States in states such as Texas, Alabama, Arizona, California, Florida, Colorado, and New Mexico. BBVA is known as the Sun Belt-based bank hold company, which simply means that BBVA is changing the way that its customers bank. So why does Business as Usual consider BBVA better than your average bank? Well, 4 years in a row, BBVA was recognized as the world's most admired financial institution in Forbes' annual mega bank list. Forrester's research company, one of the world's leading researching and consulting companies, ranked BBVA's mobile app second best in Europe. 2 years in a row, BBVA was voted Best Bank in Mexico and also Best Investment Bank. So stay tuned and listen closely as Business as Usual explains just how wonderful of a financial institution BBVA really is.
But what I would really like to go over is the supply chain management aspect of BBVA, as well as an emerging trend that's popping up and affecting banks worldwide. First thing with supply chain management. When most people look at supply chain management or they think about it, they typically think of a manufacturer. Someone or company producing a good or a product that's tangible, something you could touch, something that's on a shelf, something that you go buy from a store. Where in reality, it's really could be for any type of business producing a good or a service. Banking is a service. They're transferring funds or using these funds, funds coming in, funds going out. So first, customer, myself, a large business, small business, bringing money to a bank. It could be a counter deposit. It could be through an ATM. It could be a deposit through an application on your cell phone, mobile banking. And essentially these funds come in, that's your upstream supplier bringing the money into the bank, okay? When the money comes into the bank, essentially it's stored there and eventually processed and actually sent to a central bank. This central bank is really where the funds come in and the true liquidity of the bank is determined, and they can see how much money they can actually lend out to borrowers. Those borrowers are the downstream customers. Those are the customers that are utilizing the funds that come in from the upstream suppliers. Okay, so the money comes in, it's stored, then it's supplied to the downstream customers through a loan. Banks, how they make their money is they charge interest on these loans. These loans, they lend someone X amount of dollars, they put a percentage interest rate on it, and that's how banks make their money. Banks are definitely in business to make money, okay? Now, that's essentially the main process and the overall supply chain network for banking. Now, when we take a look at some of the trends that are popping up, it's going to be electronic banking. It's open banking. Okay. It's the younger generations that want to have complete and total control and access to their funds at all times, and don't ever want to go deal with a brick and mortar. They don't want to go to a building. They don't want to go talk to people. They simply want to have their funds at the access of their fingertips at all times. And basically, they can make accounting changes. They can look at payment data, and it's all available through application programming interfaces or APIs. Okay, customers have that great freedom of their funds, and that's what the younger generations like.
We decided to focus and learn more about BBVA's automated loan origination systems. These would be considered bank loan management systems that fall under decision support systems as our focal business process and supporting information system. So these loan origination systems that BBVA has use sophisticated models to predict the likelihood of a borrower's default for the credit product that they apply for. These models ingest information that's inputted directly from the applicant from like a web interface. Or it could be entered in from, an interviewer or some other type of intermediary, like a loan officer or a retail banker or somebody over the phone in sales. They gather this personal information such as name, social security number, income, employment, and then pull in other third-party information from credit reporting agencies. The model then ingests this data and decides whether or not it falls within, again, the bank's risk appetite. And by doing this, they've been able to streamline the approval process, the actual underwriting process, which is needed to decision the loan, and offer instant or near instant approvals. And by doing this, they've also been able to make regulators happy because they've removed human subjectivity to the decisioning process and are able to apply consistent underwriting standards to all applicants, which is critical for fair lending. But doing this, by collecting all this data on these customers, such as credit score, social security numbers, date of birth, this has put a huge emphasis on information security, because all this information is stored on a database, and there are malicious people out there that would want to use this data for malicious things. That are actively trying to breach security protocols. So another effect that this technology has had, or how it's impacted BBVA, is a heightened awareness and priority to protect this data. So there are 3 critical success factors that for the automated loan origination system to properly work. And this is the business logic, data, and the credit risk models themselves. So the business logic is used to drive the requested data that gets ingested into the system. So all of these loan products, all these credit products have guidelines and policies that regarding, income requirements, debt ratios, maximum and minimum loan amounts. So based on certain attributes, you fall within a certain category of what you can be approved for. And So hypothetically, for example, a maximum loan amount for, before you have to verify income or input income might be $10,000. So if a borrower enters in a loan amount of $5,000, then the business logic would say, okay, we don't need to collect income information. But if they enter in, a loan amount of $11,000, then the business logic, because the if-when statement would say, okay, now that I have a loan amount that exceeds $10,000, I need to prompt the borrower to enter in income information. So it's critical that the business logic that's driving the data that needs to be captured matches published guidelines and policies. The second critical success factor is the data itself. If the data is not accurate, such as in the same scenario, let's say that income information was required to be entered in, and they entered in $100 instead of, $10,000 a month as their income. Well, that would affect the debt ratio, which might fall outside of the guidelines and issue a false declination when actually they should have been approved for that loan. So it's critical that the data be accurate. And then the other critical success factor is the credit risk models. They need to successfully predict the probability of default within a relatively accurate rate at a rate. So, and which is not as easy as it sounds, because there's so many different variables that could possibly be considered to predict the likelihood of default. So they have to do statistical analysis to determine which variables to focus on, which one are more predictable. And then they have to constantly reevaluate the success of these models. Are they working within an acceptable range of error? And that's done on a cadence by a model validation team.
So, with threats to new entry, the first part, we have seen technological innovation has led to the creation of non-traditional financial services. So these would be things such as like online vendors or apps such as like PayPal or Venmo. Government regulation has also occurred, allowing commercial investment banks to merge and create these much larger banks, which has hurt smaller banks from entering the market and competing with these institutions. Competition and rivalry. What we have seen, despite BBVA's vast resources, they are only the 30th largest bank in the United States. Financial services is a very competitive market. There's also the threat of Amazon entering the market, as they are a $1 trillion industry, and it would be very, very difficult if Amazon, if they continue with their plan in the future to enter financial services, would disrupt the market completely. Another is digital cryptocurrency, which is a relatively new phenomenon, which is difficult for banks to compete with cryptocurrency because it is difficult for banks to track, which allows cryptocurrency to avoid federal regulations. Next is buyer power. So buyer power stems from BBVA's the size of their organization. So BBVA has over 7,000 branches, 50 million clients, as well as they're located in over 30 countries. So the sheer size of their organization helps with their buyer power. Supplier power stems from the customer clientele base. So the more customers and clients that an organization has, a bank has, the more supplier that they have, because they are the ones depositing their resources into the banks, as well as mortgages and loans. They're paying those back and putting resources back into these banking institutions. The final part is threats of substitution. So these would be your online lenders and and these online lenders provide traditional banking services, but in a much more convenient manner via online. Which is a very big threat of substitution for these organizations. And what we have learned is that there is a customer demand for financial services, but in terms of demand for financial services, the focus is on the rapid delivery of the services, convenience, and things of that nature. And what we have seen is that technological innovation is helping to meet those expectations in terms of demand, convenience, speed, things of that nature, and that traditional banks are going to have to keep up with the technological innovation, or they are going to end up not being able to compete with these more online, non-traditional financial services that are now emerging and competing with these organizations. An example is PayPal alone. Their clientele customer base would make them the 21st largest bank. So it is very imperative that these traditional banks become technologically sound and innovative in their solutions, and that's what we have learned. So thank you.
So, as far as recommendations for the future, we feel that BBVA should scale this solution outside of consumer and small business lending. Right now, those are the only portfolios that the loan origination underwriting has been automated. So to scale that solution, to start automating the decision making for larger commercial portfolios would give this bank a competitive advantage, because it's not a solution that any of the competitors are offering right now. So we feel like it would give them a competitive advantage for these larger loan amounts, because just like consumers, the first to offer the solution for that pain, which is the need for money, would be the first one to get the business. So being able to get these decisions faster for these other portfolios is our recommendation.